Can't hear. Just going live today. I wanted to spend some time on an article I just found. There's a lot going on in real estate right now. If you're on the internet, there's stories about deals going sideways. There's a lot of money that's been raised over the last, we'll say, 10 years, but really a lot of momentum in the last 3 years to raise money. And you hear me talking about this. It's really been a frenzy for certain groups that have popped up to raise money for other deals. Similar to something I do, but the problem is they're not doing their due diligence. They're not looking at enough deal flow, and they're getting in trouble. So I wanted to highlight this article. It's from a it's an online real estate magazine known as The Real Deal. It's kind of like the Inquirer of real estate. They really have no regard for. They just go in and bash people. Um, but I know a lot of the names in this. There are names that are commenting on the good side, and thankfully most of the ones that I know are commenting about how this has gotten out of control. So let's jump into this because the title uh, is Behind the Syndicator Machine. So syndications is a word that you probably hear me say a lot. A syndication is just simply an operator of a property or a sponsor. He needs to raise money. Let's say it's a $50 million purchase of a 200 unit apartment complex. He's going to need to raise, back in the day he only needed to raise about 10, 12, 15 million. Nowadays he probably needs to raise 15 to 20 million dollars to take down something that big. So these guys, they some of them can raise the money themselves, some of them need help. They bring partners on to help raise the money, and then it's just a free for all to try to get the money raised. And what this article starts to talk about is how this is happening and how these funding groups have popped up, which are targeting. And you can see this picture is kind of scary. That's a doctor, a pilot, and probably an engineer in the helmet. So that, but what you're seeing doctors raising money from doctors. You're seeing pilots raising money from pilots, and I know some that are doing it. And you're seeing immigrants raising money from other immigrants. So and this the real deal really does a bad job of finding. There are opportunities that are good deals, but the problem is the due diligence is not being done. They have dollar signs in their eyes. They see, and syndications have been going sideways, and I've talked about that quite a bit over the last a few years. The interest rate hike is the majority of the problem. Most of the rents have maxed out. Some rents are even falling, but it's the interest rates that have done these people in. They never have invested in an environment where interest rates were they never imagined interest rates could rise as fast as they did, and they didn't know they could get caught like that. And they've been caught in a debt service that they can't make. So, but this article, talks about syndication, and I just don't want you to think syndication is bad. I don't want to paint the picture that all syndications are bad. There are so many of them out there. The problem is there's so many young new operators who literally only learned how to buy an apartment complex in the last 3 to 5 years. They only learned how to do that, and a lot of them just plain and simple aren't good at it. They're not good operators. They may be good capital raisers, they may be good marketers, but when it comes down to collecting, to executing on a business plan, to performing the value add portion of a deal, which means they're going to go in and they're going to update the units, they're going to change out floors and carpets and get that out of there. They're going to update a plan to execute that deal on a huge scale of 200, 250 units is not easy. Some people are good at that. When you get on that scale, it usually takes a team. You usually don't see one person trying to do all that, but you do often see people that just aren't good at their jobs. You see a lot of deals that have not gone full circle. What I mean by full circle is they've bought several apartment complexes, but they may not have sold them. And that's not the whole story. They may have bought an apartment complex in 2015. They may have bought 10 in 2015, and they may have exited all those deals by 2020. And if that's the case, they probably did very well. And their quote track record looks great, because if you bought in 2015 and exited in 2020, you couldn't. It would have took a moron to have lost money during that period of time. So anyway, that's kind of the gist of this article. But it really targets, um, it targets the people who are raising money from physicians. They go in and they pitch this, hey, work less, retire earlier. They pitch this lifestyle to these investors and the physicians, and it's really it shouldn't be pitched like that. It is a way to, you've probably heard me pitch. I pitch to people on getting off of Wall Street and getting some of their money into these type of assets. But there's so much more. You can't just jump into these assets without knowing who's operating them. So it does go into the Jobs Act is why it became so easy to raise from accredited investors. Accredited investors are people who make, generally single people that are making over 200,000 a year, married people making over 300,000 a year. It talks about how things loosened up, in the capital raising world. It goes on to name some really big prominent syndicators, Tide Equities, GVA. Um, it names some people by name who have lost properties. These are some of the most popular, online. They have a very big social media and online presence. The brands are big, and they ask people, it's the lookalike audience. Okay. So, and it's weird seeing these people's names. I've met these people at conferences. You wouldn't, they're not, they didn't go in, they didn't go into these deals to hurt people or to lose people's money. Um, I know them. They didn't, they were just not well rounded, educated, and they had never been through a down market. And they're very good at convincing people. Um, the it's just really a shame that this is happening, but they're using their status as an engineer or a doctor to go raise money from other engineers and doctors. And it's easy to trust somebody that looks like you. I mean, that's sales. The job of a salesperson is to say, "Hey, I'm just like you, and look at me. I did this." And times have changed. What you did in 2015, 17, 19 can't be replicated in 2023, 2024, and in the future. Here's a company called Apple's Way that lost a $229 million portfolio, okay, to foreclosure. 123 investors in another deal, um, had lost 12.3 million of their equity. So the reason I go through this is just to show you. I don't just to scare you, because here's the deal: people are going to start running from these assets. They're going to start running from multifamily. They're going to start running from alternatives, and that doesn't mean you should run. In fact, if you're educated and you know how to perform due diligence, you know what I've been teaching you, which is to use the SMART way. What's the SMART A way? Is S stands for the sponsor. We've got to look at these sponsors. We've got to look at their track record. You got to do background checks. You got to look at track record. You got to look at their previous deals. You've got to see what deals have gone full circle. Um, I would say, yeah, and it even says it in here, 50% of the deals out there weren't underwritten correctly and are in some sort of danger. Um, or 50% of the operators. And right now, going to get by. You could have gotten by in 2015 wrong. You could have done everything wrong and still got out and made some money. Um, but it's just not going to keep happening like that. And so it brings opportunity. That's why I'm not really looking. I look at multifamily deals, but I'm passing on them right now. I've seen some decent ones come across, but I'm waiting because I do think we're going to see more distress in multifamily. One of the things you have to be careful about are some of these syndicators. They brag about the fact they've never had a capital call. A capital call is when you have to go back to your investors and ask for more money to keep the deal alive. They also brag about not being foreclosed on. And there are ways you can say that with a straight face and be telling a half truth. So I know about a deal right now where the bank has come to the sponsor and they've basically said, you're done. We're not going to foreclose, but you hand us the keys. All your investors are going to be wiped out. We're going to hand the property to a new sponsor who has a better track record than you, who has weathered these storms before. Unfortunately, that doesn't show up as a loss or a foreclosure. But if you ask all the investors that were in that deal, they lost their money. They lost every dime of their money because the bank took it back, and it may have been $100 million asset, and the bank's gonna, they're gonna readjust the debt, and maybe the debt was 70 million. They're gonna knock that debt down to 50 million. They're gonna hand it to a new operator, and they're gonna be the ones that capitalize on that new price. So you also see the avoidance. You see these workouts. That's a workout. Um, but and in essence, it doesn't go public that they were foreclosed on. But people are finding out about these because the investors are not happy. But the truth is when you invest in real estate, you when you invest in real estate equity, the property value could drop to a point where, and in residential homes back in 2008, you would have a home that was $250,000 home. The home had a $200,000 mortgage on it. But at the end of the day, at the end of the financial downturn, the home itself wasn't worth 160,000. So you had a debt of 200, a home worth 160. On a small scale, you've got a negative equity position. So if that homeowner could hang on and keep making those payments, which a lot of people could, they rent a house that was worth less than their mortgage. But now, if they held on through all this time, now they're in a house that the mortgage is lower, and now the house has doubled or tripled in value. Commercial real estate's not like that. These loans get called due every 3 to 5 years. It's very rare to get a commercial multifamily loan for longer than 5 years. It's possible, but rare. And so these loans reset. These loans have rate caps that expire, and it puts everybody at risk when these rates expire. And your original rate was 3%, and the payment on that 3% was $100,000 a month, and now the rate is 6.5%, and the payment is $195,000 a month. Payments double. So that's what you're seeing across the board. I don't want this to scare people. You're going to see these kind of articles online. I don't want it to scare you out of alternatives, but this just reiterates why you need Anyway, at the end of the day, that's what we've got. We've got an opportunity, and I want you to see that. I want you to see there's an opportunity coming in multifamily. It's not quite here right now. I'm focused on my three hot assets, which are marinas. I think the marina opportunity is huge. I think oil and gas is unbelievable right now. I just got my first check on an oil and gas deal, and we'll talk about it. Kind of, but I think there's some other assets that are going to slide up into that number three spot, and we'll talk about some of that too on another video. But again, I just wanted to go over this today. I hope you guys are having a great day. Thanks for tuning in and watching this. And again, if you'd like to talk about investing, just reach out to me. Either message me, comment below, whatever media you're seeing this on. Reach out and let's talk about investing as a group. Members of my group get to benefit from unbelievable deal flow, expertly vetted deals, and I'm not just talking about me, but professional deal underwriters who look at deals and find the problems really fast, and just the power of a group investing in these assets. If we go in as a group, we get better economics, we get higher rates of return, we get larger portions or bigger splits of the growth and of the equity. And that's why you don't go it alone. Okay, a lot of these investors got pulled in by themselves, and they're going to lose their money. So a lot of opportunities. It's really fun to be an investor in this environment. Hope you guys enjoyed this video.